Okay. How about private money mortgages?
Absolutely. We're proud of being associated with the largest private money association in the United States, which happens to be based in California, called the California Mortgage Association. And actually, I'm a co-founder of the National Hard Money Lending Association. Basically, a lot of our clients lend money to other people or to other businesses. So you can either put an unsecured note out there, or you can have a secured note. You can give a first mortgage to somebody. You can give a second mortgage to somebody. We see people now lending money to rehabbers for them to be able to buy an REO with like a 14% yield, and then saying, when you're finished modifying that and you sell it, I want 25% of the profit on top of that.
Yeah.
And cash is king right now because the banks aren't lending, and these rehabbers are still making money, so they're happy to do it. So there's so many ways you can lend money out of an IRA to make money.
Yeah. So again, this is a way that we can convert what could be a business into a passive investment. By loaning the money, you get the downside protection to some degree, that you're supposed to be paid at least your principal back. But meanwhile, you got like some sort of a minimum return in the way of interest.
That's right.
And then, defined as interest in a sense, you've got this equity participation that you can define.
So you have the cash in your IRA. The rehabber doesn't have the cash, but he's going to do all the work. You're going to get a 14% yield and then get a percentage of the profit. And you sit back and take it in. And the other thing is, if you got it secured by the property, you're probably buying that property from a bank at below market value. So even if you had to foreclose on the fellow because he didn't, fulfill his part of the deal, you'd probably have a valuable property.
Okay, a common question that comes up is from employees. Well, one, they want to know, can I put my option and exercise it in my IRA so that I don't have to report the income? And then another question is, okay, can I get the stock somehow into my IRA after I exercise that option?
Right. Many people are misinformed there. They think because they didn't exercise the stock option that it's not really an asset. But the fact is, if you have that right to buy stock, that is an asset that somebody else doesn't have. It's in your name. Joe Blow can't come along and exercise that option. And there are rules about what you can contribute to an IRA, and specifically, the only thing you can contribute to an IRA is cash through the contribution rules. That is the limit set by contribution rules, with the exception of any asset that was purchased and held in a qualified plan, like a 401k or a defined benefit plan. Those are all tax-deferred plans. They're portable to IRAs. And if you purchased an asset, one of those plans, you can roll it over tax-free to an IRA.
Okay, so folks, look at that in some detail. But some of this has to do with assignment of income rules when we talk about the options themselves. So you can't assign income away from yourself. Like even if you make a gift to your child of your option, when that child exercises the option, you're still going to be taxed on the income. And so so you can't just, unfortunately, avoid the income by making that move. Okay, let's talk briefly about the Roth conversion opportunity for this year.
Sure. This is a really, goes back to like when Roths were created in 1998. In order to get them off the ground, the government incented people by allowing them to defer the tax over 4 years. And now they're doing it again, except they're allowing you to defer over 3 years. If you convert this year, and by the way, when you convert a regular IRA, with the exception of a non-deductible IRA, which I'll talk about, to a Roth, you have to pay tax on the fair market value of either the cash or any assets that are in that IRA. And having visited with the IRS this last summer and discussing this impending change in January about all these Roth conversions, they made it very clear that we as a custodian have to get a qualified third-party appraisal of any asset that's going to be converted so that they get their just and true tax. But in any event, if you convert, let's say, a $100,000 rental property from an IRA that you maybe purchased in 2005 to a Roth IRA, maybe you do that because the value has been depressed, you don't have to pay the tax in your 2010 tax year. You can elect to defer it. Actually, you have to elect to do the tax in 2010, but if you don't elect to do it in 2010, you're required to do it in 2011 and 12. 50% of the tax hit, or 50,000 in this case, would be in 2011 and 50,000 in 2012. Now, if you make the conversion and for some reason, let's say, you converted a $100,000 asset, and in June of next year, you realize that it's gone down in value to 50,000, you can undo the conversion. It's like going to Vegas and saying, I lost 100,000, I'm going to take the money back and try it again. You can undo it, and then if you wait 30 days and the beginning of the next tax year, whichever is longer, you can take that same asset that is now worth 50,000 and convert it and only pay tax on 50,000 instead of the 100 when you converted a year earlier. So there's a lot to be learned here, a lot of opportunity. We have a lot of information on our website about that and other documents. But definitely talk to your financial advisor, talk to your CPA about this opportunity so you don't lose the chance to do it.
Okay. Getting down to the short roads here, as far as running out of time, about 2.5 minutes maybe. Maybe you have some words of wisdom that you'd like to share with people before we finish.
Sure. I think that, I mentioned this in our last talk, but I think too many people put money away in an IRA account and just leave it in the bank and don't pay any attention to it. For whatever reason, people seem to be more active with their taxable money than they are with their retirement accounts. And whether it's rebalancing your 401k or dealing with your IRA, really try to manage that for growth, because people are living longer. They're going to need more than the returns you're going to get out of CDs today to keep up with inflation.
Right.
And they need to continue to accumulate assets. And self-directed IRAs are an excellent way to do it, because you can somewhat roll with the punches. You can change out of alternative into traditional and back and forth. In fact, what we see is some of our best and largest clients really take advantage of the swings in the market. So when the market seems to be heading south, they'll get out of the stock market and go into alternatives, and then vice versa when the market starts to come back. Being in one place and with a custodian, that gives you that opportunity to go in different directions and really maximize the opportunities under the IRS rules, can really help those people that are willing to take the responsibility on to direct their own investments.
Okay. Well, Tom, I want to thank you so much for being with me today and sharing this important information, because people are looking for alternatives more these days, particularly because a lot of traditional investments just haven't seemed to work out for the last several years.
That's right.
And so anyway, so
a lot of broken promises by people's own advisors, or even the CEOs of firms, and then you have the the swindles, and also the WorldComs and the Enrons of the world.
Yeah, so many things. So anyway, so it's important to know what options that are available to us out there. So I hope maybe another time we can get together.
Absolutely.
But I wanted to thank you again for joining me here today.
Thank you.
So folks, thank you very much for watching our show today, and I hope you can join us next time for Financial Insider Weekly.